Hi. We've been looking at interest rate futures contracts as a way to hedge against interest rate risk. Now we're going to take a look at interest rate futures options contracts as a way to hedge against a risk. And it's really going to be just a little bit of an extension of what we've already been looking at. So let's take a look at a situation that we have seen already here. And this is going to be where you have a duration gap of 4.4 years, which means a positive duration gap. You're going to be hurt if interest rates go up. Okay, we've talked about that in prior videos. So what's your solution to that based upon interest rate futures contracts? You want to go short $16 million in Treasury bond futures contracts. This is the example we looked at in an earlier video. What this means then is you are obligated to sell 160 contracts at maturity, okay, when the delivery date is. Of course, you can close out the position, but you're under an obligation to be able to sell 160 contracts. Okay, well, that's going to hedge you, okay, if interest rates go up, okay. But what happens if interest rates go down? If interest rates go down, the value of the Treasury bond futures contracts are going to go up. And now you're going to have to sell them for less than they are worth. In other words, what you have done when you go into the interest rate futures contract is you have protected yourself if interest rates go up. But if interest rates go down, you wish you had never gotten into the interest rate futures contracts, because you're actually going to be making money on your underlying portfolio and losing that same amount of money on the interest rate futures contracts. So wouldn't it kind of be nice if you could wait until the last minute to decide whether you want to actually go short on the interest rate futures contracts? Well, you can. You can do that with options on interest rate futures contracts. Now, I believe at this point in your program, you have already had a course on options. If you haven't, then we're not getting into it in great detail, okay? We're going to be just describing the basics. So I think you'll be okay. But if you have, you will understand what's going on with options here. So here's what our solution is then, okay? You want to purchase the option to sell Treasury bond futures, okay, contracts. And you will only exercise that option if interest rates end up going up. So instead of selling the Treasury bond futures contracts back here at time 0, you purchase an option to sell the Treasury bond futures contracts. And then you carefully observe the situation over the weeks, over the months, however long it is. And then right before maturity, you will exercise that option if interest rates go up. You will tear up the option if interest rates go down. Now, an option to be able to sell, or it is an option to be able to go short, which is a put. You want to own the option. If you buy a put, you have the option to go short. If you buy a call, you have an option to go long. So based upon your duration gap, you have to decide, do I want to go long in interest rate futures contracts, or do I want to go short on interest rate futures contracts? And so if you want to go long in interest rate futures contracts, you will buy a call. If you want to go short on interest rate futures contracts, then you would buy a put. In neither case are you selling a put or are you selling a call in this. You want to have the option. So what happens then if interest rates move in a direction that is unfavorable to your underlying portfolio, but favorable to the interest rate futures contract, you exercise the option. If interest rates move in a direction that is favorable to your underlying portfolio and would thus be unfavorable to the interest rate futures contract, you would just simply tear it up. Well, it sounds like interest rate futures contracts are unequivocally the better options on interest rate futures contracts. It sounds like they're absolutely better than interest rate futures contracts, and they are, except comes with a catch. Interest rate futures contracts are virtually costless to enter into, whereas options on interest rate futures contracts require you to purchase that option by paying a premium. So if you have an option to go short or an option to go long, that means you are obligating somebody else to be on the other side of it. You got to pay them to obligate. To obligate them to be on the other side of this. So whoever you're purchasing the option from is going to charge you a premium. Now, we're not going to get into how the premium is calculated and all that stuff. That's done in a derivatives class or in an options class. But we just want to be able to see how this is an extension of being able to hedge interest rate risk. So let's go to our class notes on this and see what we have got, what we can add to this. Okay. All right. First of all, it's a common question. Why do we have options on interest rate futures contracts rather than just options on bonds? Well, two reasons for that. First of all, in order to be able to price an option, you have to know what the value of the underlying asset is, okay, the underlying security. Bonds, if you want to have options on bonds, you got to know what the price of the bonds are. Bonds are not traded on an exchange anywhere, so it's difficult to know for sure what the price is of the underlying bond. However, interest rate futures contracts are traded on an exchange. In fact, they're traded on the same exchange as options on interest rates futures contracts. So it's very easy to be able to see what the price is. So it makes it much easier to be able to price the options. Second, whenever you have options, there's always the possibility of a short squeeze being applied if there's an unlimited supply of the underlying security. Well, there is a limited supply of bonds out there, but there's an unlimited supply of interest rate futures contracts because anybody can enter into an interest rate futures contract at any time. There's not like a supply of it. You can always enter into it. You just have to get somebody else to be on the other side of it. So it eliminates the possibility of a short squeeze there. Okay. So a financial futures option is the right to go long or to go short on a financial futures contract at a specified strike price. The trading dates are set so that the option must be exercised in advance of the delivery date. So when we were looking back here at the diagram, what we saw is if this is the delivery date right here, the option must be exercised prior to that date. Okay, so that if you exercise the option, you can't exercise an option after you were already needed to deliver the instruments. Okay, I mean that really wouldn't make sense there. So the option has got to be exercised before the delivery date. These are always American options, which means they can be exercised at any time prior to the expiration date. And upon the exercise of the option, the futures position of the two parties will be at the prevailing futures price, and the option writer will pay the option buyer the economic benefit from exercising the option. So if you have a put option, which is an option to go short, and you exercise the option, then when you exercise the option, you immediately are in that short position where you are going to be selling an interest rate futures contract. At what price? It's going to be at the prevailing price at that point in time. So you're only going to exercise the option if you would make money by exercising that option. When do you get the money? You get it immediately when you exercise the option. The party that sold you the option is going to have to pay you that money. And they're going to have to pay you money because you wouldn't exercise the option unless they owed you money. So that's when you're actually going to be collecting the money from it, and you'll be going into the short position here. If you owned a call, you'd be going into a long position there in the same way. The person who sold you, who wrote the call, will be paying you the economic benefit of the difference between the strike price and the interest rate futures price at that point in time. So basically, all during this time, you are having the option to be able to hedge. And then you make the decision, do I hedge or do I not? Well, you hedge if the interest rates have, in this example, if interest rates have gone up, then you're going to exercise the put option. If you have a call option, then you would exercise it if interest rates have gone down during that period of time. And if not, then you tear up the option. And as with all options, you pay the premium back here So that is a sunk cost. Okay, so that's the disadvantage of interest rate futures options, is the fact that it costs something. But the fact that you paid the premium back here is not going to have any effect on whether you exercise the option. If the option is in the money, you will exercise it. If it is out of the money, you will not exercise it. So a lot of companies, what they will do is they will choose to hedge with options on interest rate futures contracts. Some companies will do a mixture. Well, they'll spend some money buying the options, and they'll maybe have like 40% of their hedging with options and 60% of their hedging with interest rate futures contracts. It varies. There's no right or wrong way to do it. Again, the negative of the options is that you've got to pay a premium, okay, whether you end up exercising the option or not. It costs you something to get into it. And of course, the positive to it is that if the option is out of the money, if you have the opportunity to be able to tear it up and not go into the interest rate futures contract if you don't want to go into the interest rate futures contract here at the last minute.